All right, so in this video, I'm going to talk a little bit about cost of capital and capital structure. I'm going to start off by talking a little bit about why we care about it, the kind of the importance of it, and what some of the basic applications of it are. So let me start off with a basic scenario. So let's suppose a business has obtained capital from lenders and shareholders who, as a group, expect a rate of return of 10% on average. Now, if we assume a constant level of risk, and we don't complicate things at this point, what happens if the business earns a rate of return of 8% as a business? Well, if you think about that, if the overall rate of return that is needed in order to keep all of the investors, lenders, shareholders, everybody happy is 10%. If the business only earns 8%, again, setting aside issues of risk, so we're just assuming that risk isn't really a factor here, then basically what this means is the business is underperforming and somebody is not going to get the rate of return that they expect, and that somebody is realistically probably going to be the shareholders. So obviously this would tend to be bad, right? This would tend to make the stock price go down. On the other hand, what if we assume a constant level of risk, what if the business earns a rate of return of 12% as a business? Well, in that case, assuming we haven't taken on any more risk, so we don't have that as a factor. And what that would tend to mean in this case would basically be that the company is earning more than what was required, which basically means the lenders are going to get what they need, but then the extra could go to the shareholders. So the shareholders would get extra return relative to what they expected. And this is going to tend to increase shareholder wealth as a result. So that would be a good outcome. So what this basically boils down to is the fact that we have to be mindful of what rate of return do we need to earn for all of our investors overall, because that winds up being something that we judge our performance as a business by. So we have to look at that. And so if investors as a whole are requiring 10%, I need to get 10% or higher, assuming that the level of risk is constant. We haven't changed anything with that. And there aren't any other market circumstances that would change what investors are requiring and so forth. So basically what this means then is that the cost of capital is the rate of return a firm needs to earn overall, so in its entirety, on its investments to keep all of its investors, so all lenders, shareholders, all investors of all sorts, happy. And that's holding all other things equal. So including risk, we aren't changing that at all at this point. Now, if you think about that, then basically some possible applications of this would be stock valuation. So if you are trying to value a share of stock, some approaches, if you've studied the free cash flow approach, for instance, they require a weighted average cost of capital, or the rate of return that all the investors are going to require in order to calculate the value of the stock when doing some of those free cash flow as a whole approaches. So that would be one possible application. Also, capital budgeting would be an application of this. So if you're thinking about capital budgeting and trying to assess projects, after we have adjusted that weighted average cost of capital that we're going to get to, or the overall cost of capital that we need to earn, after you've adjusted it for the risk of a project, so we do have to factor in risk at the end of the day, but after you've adjusted for risk, then that's going to apply for capital budgeting purposes. So when we're assessing a piece of equipment or perhaps a new facility to purchase, cost of capital matters. So we're gonna have to look at that. We would have to adjust for risk, but we have to incorporate it. And basically anything that involves the use of the firm's capital generally. So if that's whether it's marketing expenditures, product decisions, whatever, if it's a use of the firm's capital, we need to be getting an acceptable rate of return on it. And so that's why we're going to care about the cost of capital. And the cost of capital is going to be very much linked to the capital structure. So when I say capital structure, what you should be thinking of is basically just the mixture of debt, common equity, and preferred stock that a firm used to finance the business. So different businesses use different mixtures of those, and that's what capital structure is all about. What mixture do we have? So that's why the cost of capital is important. That's why we care about it. And hopefully this video has been helpful. Thank you so much for watching, and have a great day.